We are seeing oil and gas prices jump. Earlier today, Brent crude was trading at a four-year high of $126 a barrel.
Bank of Canada held interest rates steady in their decision this week, but warned the ongoing risk is already causing inflation, and it could get worse.
Canada is being buffeted by global events and geopolitical uncertainties.
$105 a barrel today after spiking to about $107 to start the day.
Your support is free, but priceless. Subscribe to Canada Scope. Canada is shaken as a major oil crisis hits, and suddenly the nightmare feels way too real. For years, Mark Carney and the federal government in Ottawa pushed the idea that Canada's resource wealth would act like a safety net. Critics say they leaned too hard on that belief, missed serious warning signs, and moved too slowly when tough decisions had to be made. Now, a global supply shock is putting that whole strategy under a brutal spotlight. The first thing to look at is the size of the global hit, because this is where the political excuses usually begin. Officials can say the crisis started outside Canada, and yes, part of that is true. But the outside shock still has to be faced honestly. If the Strait of Hormuz shuts down, around 11 million barrels per day can be taken off the market almost instantly. That is not a gentle slowdown. That is supply getting ripped away overnight. Then add another scary layer. 500 million barrels disappearing from global inventories. Shipments already on the water get frozen mid-route. Ports slow down, buyers panic. Oil was already sitting around $105 to $107 per barrel, and then it jumps another 57% in just 1 month. Across parts of Asia, fuel rationing has already begun. Work weeks are being shortened, jet fuel is being controlled more tightly. And while all of this is happening, Mark Carney still sounds like Canada has room to monitor the situation. Monitor what exactly when the pain is already moving through the system? This is where things get ugly for Canada, because the country was not as surprised as some politicians want people to believe. Canada spent years telling itself that oil reserves meant energy security. That was the big pitch. You are safe because the country is rich in energy. But that line falls apart fast when regular people are staring at the pump and wondering if they can afford a full tank. The economy is barely moving, sitting around 1% growth, and now recession fears are getting louder. That does not look like strength. It looks like a weak setup that only needed one global shock to expose every crack.
That this supply shock has dissipated and that inflation is definitively on its way back to the 2% target. Now, the Fed was always sort of in that situation that it needed to be able to say, look, we're on our way to the target to justify cutting, but the existence of a supply shock has pushed forward the date when it will be able to make that declaration.
In many parts of the country, that gas tax relief that we saw from the federal government, never mind, the tax isn't there, but the price you're paying at the pumps is either going to make up for that or will be more than it was, Arthi.
CPI inflation rose from 1.8% in February to 2.4% in March. Core inflation has been easing and held steady just above 2% in March. The proportion of the components of the CPI basket rising faster than 3% has also declined in recent months. We will also be closely monitoring inflation expectations. Near-term inflation expectations have moved up with higher gasoline prices and still elevated food price inflation. But longer-term inflation expectations remain anchored. Based on recent market expectations, oil prices are assumed to decline from an average of about $90 a barrel in the second quarter to about $75 a barrel by the middle of next year.
Because we've seen that spike at the pumps for people in North America, what do you expect from the Federal Reserve then next week?
We don't think the Federal Reserve is going anywhere next week or for the next couple of meetings. Now that this supply shock is in train, is on the way, we don't believe the FOMC will be able to cut rates until it has definitive evidence.
Economic problems around the world, the recessions. And today, only as of today, we lost 11 million barrels per day.
This very clearly is the worst energy crisis of our lifetimes. We have lost over 11 million barrels per day of production.
The image Carney and Ottawa tried to sell did not slowly fade away. It cracked in public, in real time. And the biggest contradiction is almost too wild to ignore. Canada has massive oil reserves, among the biggest on the planet, yet ordinary families are cutting back on driving because fuel costs are squeezing them. How does a country produce energy at scale, but still struggle to deliver affordable energy to its own people? That is not just bad luck. That is where policy choices come under serious pressure. For years, infrastructure plans were delayed. Projects were challenged and energy became a political battlefield instead of a practical economic priority. Now, when global demand spikes and prices rise, Canada is not in the strong position it should be in. This is not only a missed chance, it looks like a costly mistake made at home. Then you look at the gas station, and that is where the crisis hits people right in the wallet. Gas is around $1.70 per litre nationally. But some parts of the country have already pushed past $2 per litre. Diesel has crossed that line too. On the West Coast, prices are near $2.17. On the East Coast, they are close to $1.88. These are not tiny bumps. These are numbers that make people change plans fast. Families are not just complaining online, they are moving different. They are driving less, skipping extra trips, and asking whether every errand is worth the fuel cost. And that pressure does not stay at the pump. Once fuel prices move like this, everything connected to transportation starts moving too. Shipping gets more expensive almost immediately. Trucking companies pay more for every kilometer, and those costs do not just disappear. They move to retailers. Retailers move them to customers. Groceries rise, basic goods rise, and suddenly the oil crisis is not just about energy. It is about every bill landing at your door. And Ottawa's answer? More careful statements about watching inflation and protecting stability. Stability for who exactly? Because from where many Canadians are standing, that stability is not showing up in daily life. Now we get to the part that really shows how unprepared this whole system looks, and that part is infrastructure. This is where the clean speeches stop sounding so clean, because Canada cannot physically move enough oil to fully benefit from the position it should be in. The oil is there, the demand is there, the prices are high. But the system to move that energy is already stretched thin. The pipeline network is already under heavy pressure, and there is no huge extra capacity just sitting there, ready to answer a sudden jump in global demand. That is the real issue. Canada can talk about being an energy powerhouse all day, but if the product cannot get where buyers need it, then that power stays trapped underground, or stuck inside a slow-moving system. The Trans Mountain expansion finally got built after years of delays, legal fights, political arguments, and endless drama. And yes, it added capacity. But even that is not enough to fix the bigger problem. One major project after a decade of fighting, and Canada is still behind where it needs to be. That says a lot about how slowly things move when Ottawa is in charge. And this is where critics start asking the hard question: how can a country with this much oil move this slowly during a global energy shock? This should have been the moment where Canada stepped up, sold more, earned more, and strengthened its place in the world market. Instead, the country is stuck dealing with bottlenecks that should have been addressed years ago. Then you have the Pathways project sitting there, a $24 billion pipeline plan still caught in approvals and environmental reviews.
Since our previous forecast in January, the war in the Middle East has sent global energy prices sharply higher, increased financial market volatility, and disrupted shipping for fertilizer and other commodities.
We can't just turn it into diesel fuel for trucks and ships and trains. So it's fair to say that the U.S. is more insulated. It's fair to say that Canada is more insulated, but no country is an island in the global economy. And global trade matters for every economy.
Growth looks to have resumed after contracting at the end of 2025. Consumer and government spending are contributing to growth, while U.S. tariffs and trade uncertainty are weighing on exports and business investment. The labor market is soft, with the unemployment rate remaining in the 6.5% to 7% range, reflecting both weak hiring and fewer job seekers.
While Canada keeps debating, global buyers are not sitting around waiting politely. They are locking in supply contracts somewhere else. They are going to producers who can deliver right now, not producers still stuck in paperwork. That is where the money starts slipping away. We are talking about billions of dollars in potential revenue that could be moving through the Canadian economy. Jobs, investment, tax revenue, business growth, all of that gets weaker when the infrastructure is not ready. And the most frustrating part is that the resources are not missing. The problem is the system built around them. That is the part Mark Carney and Ottawa do not seem eager to talk about, because this cannot all be blamed on the global crisis. This part is domestic. This part is about years of slow decisions, blocked projects, mixed signals, and a government that wanted the benefits of energy wealth without fully dealing with the hard work needed to move that energy. Now let's talk about the part that makes the situation look even more exposed, because this is where Canada's emergency planning starts looking thin. Canada is the only G7 country without a strategic oil reserve. Let that sink in for a second. Every other major economy understands that energy shocks are not some fantasy. They happen. Supply gets disrupted, prices jump, markets panic. That is exactly why emergency stockpiles exist. They are there to soften the blow when the world gets messy. But Canada does not have one. And yet you still hear big talk about stabilizing markets, managing supply, and protecting consumers. Managing what exactly, when there is no reserve to release? How do you calm a supply crisis when you do not have emergency supply ready to go? Other countries can at least slow the damage. They can release some stock, calm panic, buy time, and give their economy a little breathing room. Canada does not have that same cushion. It takes the hit straight on. That is not strength. That is exposure dressed up like confidence. And this looks even worse when you realize how fast the global situation is moving. Shipments are already being disrupted. Supply chains are tightening in real time. Prices are reacting immediately. Markets do not wait for committee meetings. They do not wait for another round of careful statements. They move fast, and Canada's system looks painfully slow by comparison. There is no real buffer, no strong cushion, no emergency mechanism big enough to soften the first blow. That means the pressure moves straight to consumers. It shows up at the pump. It shows up in delivery fees. It shows up in grocery prices. It shows up in every basic cost people already felt was too high. So when Ottawa starts talking about rebates or temporary relief, people have every right to ask the obvious question. Where is the actual fuel supposed to come from? A rebate might help someone pay a bill for a moment, but it does not create missing supply. It does not replace barrels that are not there. It does not fix pipeline limits. It does not magically calm a global market. Money does not replace fuel. Announcements do not replace missing barrels. And without a stockpile, every promise sounds like it is coming from a weak position. Now add inflation on top of all that, and Mark Carney's situation starts to look like a trap closing from every side. Inflation is already pushing past 3%, and that is before the full impact of higher oil prices works through the economy. Everyone knows what comes next. Energy prices rise, transportation costs rise, production costs rise, then businesses pass those costs down the line. That is how a fuel crisis becomes a grocery crisis.
It's still very, very high compared to before, and that is, of course, what's driving up the price of gasoline, jet fuel, all sorts of other things. And Canadians will have probably either noticed already today, noticed last night, or they will notice as today continues that gasoline prices are shooting up in this country again.
Anis, what are some of the reasons behind the ongoing increase?
So this surge really, which took that international standard oil price, Brent crude, to a 4-year high, is mostly, or at least significantly, because of these concerns over the conflict re-escalating near the Persian Gulf at the Strait of Hormuz between the U.S. and Iran. But there's really a lot of, we don't know what's happening next, and we don't know what's going to happen in the minds of commodities traders. And when they are unsure about something, typically that drives the price up. There's also this sort of financial confusion happening, is maybe the way that I would put it, because the price that we're seeing, that we quote, this, Brent crude oil price, that's a futures price. That's what traders expect to pay at a certain point in the future for a barrel of oil. But the price that they need to pay for an actual physical barrel of oil is much higher. And the price that's projected across different months is also sometimes higher, sometimes lower. So there's
a rent pressure problem, a business problem, and a family budget problem. It spreads fast. One price shock turns into 10 different problems, and regular people end up paying for it every week. This is not complicated. It is a chain reaction, and people have seen it before. The real problem is that Carney does not have a clean escape route. Raise interest rates, and you hit housing, which is already stretched badly. You slow spending, squeeze small businesses, and push the economy closer to recession. But if rates stay steady, while inflation keeps climbing, people lose buying power even faster. That is the brutal corner Canada is standing in right now, and that is why this crisis feels bigger than oil. It is not just about barrels, pipelines, or pump prices. It is about a country that was told it had protection, only to find out the protection was thinner than advertised. That is the position all of Canada is sitting in right now, and it is not a comfortable one. This is exactly why the central bank looks stuck. The supply shock means cutting rates anytime soon becomes extremely risky. They need inflation to cool down, but the thing pushing inflation higher is still active. Oil is still expensive. Fuel costs are still moving through the economy. Transportation is still getting pricier. So what do? They wait, and that waiting game is painful. Households wait while bills keep rising. Businesses wait while profit margins get thinner. Workers wait while the job market gets weaker. The whole country is basically being told to hold steady while the pressure keeps building. That does not look like strong leadership. It looks like a system trapped in a corner. And the worst part is that this did not come out of nowhere. For years, loose policy, slow planning, and weak preparation built an economy that looked fine when conditions were easy. but could not handle serious pressure. Now the pressure is here and the cracks are showing exactly where people expected them to show. Then you look at the real economy, not the clean political talking points, and that is where things get uncomfortable very fast. Canada lost 84,000 jobs in a single month. That is not a tiny adjustment, that is a serious drop, the kind that makes people stop and ask what is really happening underneath the surface. And of course, the official explanation leans on global factors. Global oil shock, global uncertainty, global pressure, fine. Global factors matter. Nobody is denying that, but that does not explain why Canada's domestic economy is reacting this badly. A strong system should bend under pressure, not start snapping right away. Companies are getting hit from every direction. Energy costs are higher, borrowing costs are higher, customer demand is uncertain. Planning becomes harder, expansion becomes riskier.
I have to tell you though, we just went through the largest trade crisis we had ever seen. Now we're piling on another so-called supply shock. The difficult answer here is when we see things we've never seen before, we don't know exactly how they're all going to pan out.
Gas pumps are among the first places that global consumers are feeling the pinch. Motorists are especially hard hit by higher fuel prices. The increases vary from country to country with knock-on effects feeding through to the rest of the economy.
I didn't used to. I used to drive my kids to a lot of places. Now I can't afford that.
Second, after more than a year with inflation close to the 2% target, higher global energy prices are pushing inflation up. The surge in gasoline prices combined with still elevated food price inflation is squeezing more Canadians.
How does an oil blockage halfway around the world in the Middle East affect the price of gas here in Canada so quickly? Like, almost none of the oil that tankers carry through this tiny little waterway that Iran has blocked even comes to Canada. The vast majority goes to Asia. And yet, gas prices here, up and up and up.
Until the war, we expected inflation to stay close to the 2% target. But sharply higher gasoline prices are now pushing up inflation.
So what do businesses do? They protect themselves, they cut staff, they freeze hiring, they cancel projects, they delay investment. That is how the slowdown spreads through the economy. It does not happen in one dramatic moment. It creeps from one company to another, one industry to another, one household to another. First, the business owner cuts hours. Then the worker loses income. Then the family spends less. Then another business sees weaker sales. Then more layoffs follow. It feeds on itself, and that is the dangerous part. At the same time, households are already dealing with rising fuel costs, rising food prices, and rising mortgage pressure. People are not just looking at one expensive bill. They are getting hit from every angle. Gas costs more. Groceries cost more. Debt costs more. Rent and mortgage payments are still heavy. Insurance, utilities, and basic services keep eating into paychecks. So where does the adjustment happen? It happens in the places people do not like to talk about. It happens in savings accounts. It happens on credit cards. It happens when families quietly cancel plans, skip purchases, delay repairs, or borrow just to keep their current life from falling apart. That is not real stability. That is survival mode with a polite name. People start using credit not for luxury, but for basics. Groceries, gas, bills, school costs, car repairs. And once that starts, the pressure gets nasty. Interest builds, payments grow, stress rises, one expensive month turns into 2, then 3. Then suddenly people are not just dealing with inflation anymore, they are dealing with debt on top of inflation. That is the slow squeeze. It does not always look dramatic on day one, but it gets worse over time. And the longer officials keep pretending that the economy is stable, the more disconnected they sound from normal people's lives. Because stability is not a press release. Stability is not a calm speech from Ottawa. Stability is whether families can fill the tank, buy groceries, pay the mortgage, and still have something left at the end of the month. Right now, many Canadians are looking at their bank accounts and seeing a very different story from the one politicians are telling. They are being told the system is under control, while their daily costs say the opposite. They are being told leaders are managing the crisis, while businesses are cutting jobs and households are leaning harder on debt. And that is why this moment feels so serious. It is not just an oil shock anymore. It is a test of whether Canada's economy was actually strong, or whether it only looked strong when money was cheap. Energy was stable and global markets were calm. Now the calm is gone. The pressure is real, and Canadians are the ones carrying the cost.